Good afternoon, everyone. This is Vaniki Joshi-Lohani from MBA department from SGS ITS Indore. Today, I would be dealing with the extension of beta, and here I would be working on capital asset pricing model theory. This capital asset pricing model is basically nothing but it is a further extension of beta. That is, as we have dealt that beta was evaluation of risk of different securities and different portfolio. So in this model, we would be using that risk of a particular security or of a particular portfolio to understand how to gain the return from that particular risky asset. Initially, starting with the first thing, assumptions. Capital asset pricing model has the following assumptions. It is equilibrium model that underlines all the modern financial theory, and it is derived from the principles of diversification with simplified assumption. And it is an individual. Here it says that individual investors are price takers. There is no arbitraging. There are no taxes. There are no transaction costs. Investments are limited only to the trading financial assets, and only single period investment horizon is available. Our expectation from this model is, here we assume that there is a risky asset I such that it has a certain price. Then how do we find out the return of that particular risky asset, considering the risk-free rate of return and the risk premium of that particular asset? So CAPM tells us what is the price of the risk and what is the risk of the asset. Initially, by using beta, we calculated how to quantify risk. And now here we will try to find out what is the price of the risk. Assuming that there is a particular asset I and asset J, having an expected return of 10.9% and a standard deviation of 4.45% and 7.25%. This is nothing but this is the beta which we have calculated. Now to find out whether which particular asset I or asset J, would be providing us better return. Here in CAPM, we try to quantify the risk by using the following equation. Here we consider the risk-free rate of return, that is the rate in which the rate of return of the FDs, the rate of return of the bonds, the rate of return of the treasury bills, basically those assets which give us a return with zero risk. It is also known as alpha, plus risk premium of specific asset I. Now this risk premium, here we introduce beta. Beta again is nothing, it is the covariance of particular asset I with relation to market upon the variance present in the market. So here expected return or return of a particular asset can be said as RF, where RF is nothing, it is the risk-free rate of return, that is the rate of return of bonds, rate of returns of treasury bills, rate of returns of government bonds and government securities, plus risk premium. Risk premium is expected market return, that is the expected return which you are about to get from the security, minus RF into beta. Beta here, risk, would give us the idea that if the beta is higher, return would be higher. If beta is lower, then return would be lower. Ideally, we can say that the simple expected return and beta, when mapped together, they can give us an ideal slope of 45 degree. This is known as security market line. This is the ideal condition of a particular security or of a particular portfolio to fare in the environment where beta is 1. Now assuming that a particular security has a higher beta or a lower beta, then depending upon those situations, we can say that a portfolio or a security will lie either above the market line or below the market line. And this is known as capital market line. Thank you so much.